Macy, for example, in May, introduced the Abolish the Federal Reserve or End the Fed Act. It hasn't really been passed, as you know. But it says here Americans are suffering under crippling inflation, and the Federal Reserve is to blame. During COVID, the Federal Reserve created trillions of dollars out of thin air and loaned it to the Treasury Department to enable unprecedented deficit spending. By monetizing the debt, the Federal Reserve devalued the dollar and enabled free money policies that caused the high inflation we see today. This is the press release.
There have been times in history when the gold standard did work pretty well. I assume people who want to end the Fed want to go back to something like a gold standard. It would be hard to go back to it unilaterally.
We're joined today by economist Carola Binder. She is the associate professor and chair of economics at Haverford College. She's an Ember research associate, and we're talking about her work on inflation and central banks. She's also the author of Shock Values, Prices, and Inflation in American Democracy, released earlier this year. Welcome to the show, Carola.
Thanks a lot for having me, David.
I want to talk first about inflation. That's a topic that's been on everyone's minds. Although the inflation rate has come down from its peak at 9.1%, the question still remains whether or not it will linger. It does affect Fed policy, which we'll talk about in more detail in just a bit. What is your outlook on inflation currently?
My outlook is pretty good. Inflation seems to be gradually coming down. There's some blips here and there each month. The numbers sometimes come in a little higher, sometimes a little lower than expected. But I think we're making slow but good progress back to the Fed's 2% inflation target.
The Fed has stated numerous times, including at the last FOMC and in their minutes released last week, that they need to see conclusive evidence that inflation is headed towards their 2%. They didn't say it needs to be at 2% before it cuts. Okay. They said that it needs to head towards. What is this evidence? What do we need to see in the economy that will convince the Fed that the inflation is without a doubt heading down?
I think they need a couple of months in a row of solid readings where inflation is declining or at least holding steady for several months in a row without any upward blips. So yeah, the Fed they want to act preemptively, so they don't want to wait until inflation is all the way to 2% or even below 2% before acting, because of their sense that monetary policy works with a lag. So if they see inflation start to trend down, then they'll feel like it's going to keep trending down, and they would start to tighten even before getting all the way to or even below 2%.
How important are expectations for inflation? This is a quote from former Fed Chair Ben Bernanke.
The conventional story, again, which is dominant in central banks around the world, rests on two key premises. First, that inflation expectations are an important determinant of realized inflation. In particular, inflation expectations help to determine inflation dynamics, including the persistence of shocks to inflation and the sensitivity of inflation to other economic variables. The second key premise is that central bank behavior and possibly central bank communications can influence inflation expectations, and through them, macroeconomic outcomes.
Generally speaking, Carola, do you agree that inflation expectations can actually cause inflation one way or another?
I mostly agree. So both of those two premises that Bernanke laid out there, both of those are subject to a huge amount of empirical research in recent years. It is hard to find, conclusive causal evidence of expectations causing inflation and of central banks affecting expectations directly. So both of those, they intuitively seem correct. They're hard to find really strong empirical evidence for, but I think that there is at least some empirical evidence for them, at least over longer periods of time, and at least with major movements in expectations. Like if you have expectations really de-anchor the way they did during the 1970s, I think that really can raise inflation. And when you have smaller fluctuations in expectations, they're moving from 2.4 to 2.5, whether that really matters, I think is a lot harder to tell.
Do you think there is a sort of a self-fulfilling prophecy whereby if the Fed is telegraphing lower inflation, people will probably adjust their consumer spending and patterns accordingly?
There can be. At this point, I don't think that the Fed is likely to be able to just convince people just by saying so that there's going to be lower inflation. Having experienced this bout of high inflation, I think people really need to see it for themselves before they'll just believe the Fed that inflation is declining.
Mm-hmm.
So I think there is some kind of stubbornness and expectations now that people have experienced just how high inflation was.
One of the most commonly submitted feedbacks to me, at least for my show, is that the BLS data doesn't accurately capture what's actually happening, or at least is reflective of people's real life experiences. Have you, through your research, observed any either measurement errors or inconsistencies with what inflation is on the street?
Well, inflation is different for every household because
Sure.
everyone buys different things. I mean, I have 5 kids and 9 chickens, so my experience inflation is going to be quite different than most people's. But so there is that sense, and even if the BLS is kind of perfectly accurately measuring the inflation of an average person's consumption basket, no one is exactly average. There's also difficulty, and the BLS has worked for decades trying to address the difficulties in measuring inflation when you have quality change. So if you have cell phones today are not the same thing as cell phones 10 years ago, and that makes it hard to measure inflation accurately. Cars today are not the same as cars 10 years ago. There's also just big issues with how to measure house price and rent apartment price inflation, right? Because of imputed rents and just houses that are not selling very frequently. That causes huge measurement issues. But there's also, like, people might have confusion between the level of prices being high and the level of inflation being high. So even though inflation has slowed down, prices are still rising. And they're still high. So that's another reason why people might feel like inflation is higher than the BLS says. It's just like a different understanding of what inflation actually means.
Is there any reason to suspect that they're using measurements that would purposely make the inflation rate lower? I've heard the argument from some economists that if you were to take the measurement methodologies of pre-1981 or 1980s, you would actually have a much higher number. Is there any truth to that?
Well, there were various commissions in some of those years to address measurement issues with the CPI. They realized, for example, that quality change wasn't really being dealt with appropriately, and that as a result, inflation was being, I believe, overstated. And so there have been revisions to how the CPI is calculated. So it is true that if we measured the CPI using old methods, we would get different numbers. But I think the idea of those changes was to make inflation measured more accurately. When the Fed adopted its 2% inflation target, that was actually because they thought that 2% measured inflation really meant 0% inflation, right? They thought there was some bias upwards, so that because of the way the index wasn't capturing quality change and some other issues, they thought that maybe 2% measured inflation actually was 0% actual inflation. And so over the years, that kind of bias through different methodological adjustments has been reduced.
What do you think overall of the 2% target? Is it, in your opinion, the golden growth rate such that we have full employment at 2% and also sustainable growth?
I don't think there's anything really like magical or golden about 2%. I think it was selected partly because of that issue, that 2%, they thought maybe that would actually give us something like actual price stability. Also, there was just some historical precedent because the Reserve Bank of New Zealand had already selected a 2% inflation target. There was also concern that, we needed something a little bit above zero to avoid being at risk of deflation coming too often. So 2% was kind of chosen as this number that was like pretty close to zero, but a little bit above zero. Nice, kind of even round number, like easier for people to remember than 1.57 or something like that. But it's not that it's the result of some optimization problem that spit out 2%. Now that we have it, though, I think it would be pretty dangerous to adjust it and say, well, actually, let's go with 3, or actually, let's go with 4, because that would kind of hurt the Fed's credibility to be changing now that they've committed to 2%.
Do you think that in theory there is a better, more optimal number?
In theory, well, so I think a lot of theoretical models, the optimal is 0, but there's also different theoretical models where the optimal is something closer to 2. So I don't have a strong opinion on that one. I don't think it would be something much higher than 2. But I can see the argument for having something like 2 rather than having 0.
One argument I heard is that the Fed should just, along with other central banks in its peer group, should just abandon 2% and make it 3. That would alleviate some stress in the credit markets, at least for keeping rates too high for too long. What do you think?
I think that with 3% inflation, well, one is just the transition would be very disruptive. Going from years of targeting 2% to saying, actually now we're targeting 3%. That would cause, at least in the short run, a lot of disruption. Maybe people would have a harder time believing central banks in the future after that. I also think with 3%, I would find it harder to say that 3% actually is consistent with the price stability mandate that Congress has given the Fed. I think people are going to notice that more than 2% because prices are going to be doubling, that much more quickly. So I think Congress would push back if the Fed were to say, we think 3% inflation is consistent with our mandate. Congress might say, no, we don't think that's consistent with with the responsibilities that we delegated to you to maintain price stability.
Okay, I like to ask you about actually methods of maintaining price stability. How do you feel about price controls? There's, people from both sides of the debate. I've talked to economists who believe that it's not actually productive. What ends up happening is you get shortages in the supply chain. I spoke to David Dodge, who was a former Bank of Canada governor, and he said that, and I'll just paraphrase what he told me. He said that he implemented price controls in the 70s. It worked. He's suggesting that after the price controls in the 70s would also have worked in the U.S. as well. He said we've gone through a period since mid-60s where every year inflation got a little bit worse. What we were trying to do with the anti-inflation board, which is what they called it in Canada at the time, was to move inflation expectations and actions down in line with a decrease in demand. Where do you stand on this debate?
I think that in general, price controls are a bad idea. Like you said, they would result in shortages. Prices send a very important signal. They help coordinate production and consumption in a way that government really just doesn't have the information to be able to do. I mean, in the book, I talk about various episodes of price controls in U.S. history, and there are some occasions when they work better than others, like in the world wars, for example, in major wars, when you have everyone agreeing that in the short run, what we need is to win this war. What we need is to mobilize the economy for the war effort. Then they can help for a short time, because you don't really need the markets to send these signals about what people want to consume. What people want is to win the war, and they have these shared short-term goals. So I think in World War I, there was some success of price controls, although they brought about big challenges too. But in general, no, I think in general, they're not an effective method for reducing inflation. They can reduce inflation expectations in a wartime. They can reduce inflation, but with big real costs. Right?
What do you think is the most likely course of action for the Federal Reserve for the remainder of the year?
I think for the remainder of the year, it seems likely that they would cut rates maybe one time, so 125 basis point cut. I think recent inflation readings have been pretty promising. They really don't want to promise anything about the path of rates they're going to take. They really want to convince people that it's going to be very data dependent. But if the data, I think, goes the way they're expecting, then probably one rate cut and then more in the following year, provided, again, that the data keeps going as they're thinking it's going to go.
You've done a tremendous amount of research on central bank independence. In one of your papers, you've showed that 10% of central banks face political pressure, even in countries which have supposedly, quote unquote, independent central banks. Can you elaborate on this, summarize your findings for us?
Sure. So this was a paper that used data only through 2018, but on 118 different central banks. I was reading these country level reports from the Economist intelligence unit and writing down each quarter whether there was discussion of political pressure on those central banks. It was almost always pressure for easier, looser monetary policy. It came from all sorts of governments, but more often from populist governments. And yeah, I think that, again, like this data only went through 2018. In more recent years, we may have seen even more political pressure on central banks to do more during the COVID pandemic, also during the inflation surge.
Okay. Were there any particular central banks in your findings that surprised you the most?
A lot of it wasn't too surprising. A lot of the higher inflation Latin American countries really faced a lot of consistent pressure on their central banks for easier policy or pressure to help with monetizing the government's debt. But yeah, it was surprising that this pressure wasn't really correlated at all with measures of de jure, like legal central bank independence. So even central banks that had a lot of legal protections for the central bank still had very little, or kind of very little insulation from the central banks being subject to political pressure.
And usually, how did the central banks respond to this pressure?
Well, a lot of the time they resisted it. So when I was kind of coding up this data set, I was recording whether they resisted the pressure or succumbed to the pressure. It was more often that they would resist the pressure, but even then that resulted eventually in higher inflation, potentially through some kind of expectations channel where people would see that the government keeps trying to get the central bank to do easier policy, maybe it's going to work, and then they would expect higher inflation and inflation itself would rise.
Okay. Have you observed any such pressure in the U.S.? One theory is that Nixon pressured Arthur Burns at the time to enact more expansionary monetary policy. There's been a lot of discussion and research done around that topic. What's your take?
Yeah, there's evidence from audio recordings of discussions in Nixon's office, discussions between Nixon and Burns, showing that he was pressuring Burns for easier monetary policy in advance of his re-election. So I think that's pretty well documented. I think more recently, like pre-COVID, but in around 2018, 2019, there was this sense in the US that inflation really was a problem of the past, that if anything, inflation was just too low and it was going to stay low, and that the Fed should not be worrying so much about inflation and should really just do everything it could to boost employment. I think we saw this reflected in the Fed's changes to its framework when they adopted average inflation targeting and took an asymmetrical approach where they said they would make up for undershoots of inflation from target, but not for overshoots. And this, the idea there was to boost inflation and really let the Fed wait as they saw inflation rising, let the Fed wait to tighten to give the labor market a chance to get even stronger. And they thought that, this is what people wanted and that it didn't carry a very big risk. But in fact, inflation wasn't really a problem that was totally in the past.
Which force do you think has more of an impact right now on inflation, monetary policy or fiscal policy?
Well, I think that it ultimately is always down to monetary policy because we have a regime of monetary dominance in the US where the Fed is delegated this responsibility for price stability. So no matter what fiscal policymakers do, it's ultimately on the Fed to counteract that, to keep prices stable. Fiscal policy can certainly make the job of monetary policymakers a lot harder. Right? If there's a big fiscal stimulus that's going to be really inflationary, then the Fed has a harder job of maintaining price stability because they have to counteract that, which could be potentially quite costly. But it is like the Fed is supposed to kind of act last and be the one that keeps inflation near target.
Finishing off on central bank independence, I actually had the chance to speak with the governor of the New Zealand Reserve Bank at the time of the first inflation targeting, Don Brash, and he told me that. Well, I asked him why is it that he implemented this policy, and he said, "Well, we were basically just approached by the Minister of Finance to control inflation. That was our task. The 2% target was just something that was discussed internally and decided upon." And I asked him, "Well, did you consider yourself independent?" He says, "Well, in that regard, certainly not. We were just acting on the behalf of the Minister of Finance." So, what is your view on independence overall? Should the central bank remain independent as an entity, or should it more closely coordinate with the Treasury, the Minister of Finance, perhaps even Congress?
Mm-hmm. I think central bank independence is important, but it's important to remember what it means. In the US, the Fed is accountable to Congress. So even though the Fed has this independence to pursue monetary policy as it sees fit towards its objectives, it's Congress that gave it its objectives, and it's Congress to which the Fed is accountable. So if Congress can always they could always change the Fed's mandate. They could always change the rules governing the Fed if they thought that the Fed was not achieving its price stability and maximum employment goals effectively. I don't think that more coordination with the Treasury or more kind of executive branch involvement in monetary policy would be a good idea. I think you get you really make the central bank more susceptible to political pressure when you do that. And even in New Zealand, really the Reserve Bank of New Zealand was the first to adopt inflation targeting, but it has added more goals. It's added an employment goal, and it's even added, I believe, a house price goal in recent years. I think partly because of the way its independence is something that's structured differently than in the US, and it has been susceptible to some populist pressures.
Well, in your book, you've actually discussed the movement to end the Federal Reserve. This is still ongoing. Some members of government are still advocating for this. Macy, for example, in May, introduced the Abolish the Federal Reserve or End the Fed Act. It hasn't really been passed, as you know. But it says here, Americans are suffering under crippling inflation, and the Federal Reserve is to blame. During COVID, the Federal Reserve created trillions of dollars out of thin air and loaned it to the Treasury Department to enable unprecedented deficit spending. By monetizing the debt, the Federal Reserve devalued the dollar and enabled free money policies that caused the high inflation we see today. This is the press release. Lots to unpack there. First of all, do you agree with that statement? And second part of the question, should we end the Fed?
Okay, the first part of the statement, well, I think that the high inflation that we suffered through in 2021 and after was a result of both supply and demand side, and it was very hard in real time to disentangle those two things. And a good central bank, following kind of optimal monetary policy should, quote, look through supply shocks. So they shouldn't try to respond to supply-driven inflation. They should respond to demand-driven inflation, but you can't really see which is which. And I think that, the Fed might have erred on the side of under-responding a bit, but it would have been hard for anyone to have made tremendously better decisions. There was certainly some supply chain issues, some supply side inflation that sort of had to happen. And I think the Fed does acknowledge that there were some policy errors. They're going to have a new framework review, and they're going to try to improve in the future. So I'm not a Fed apologist. I'm critical of the Fed, certainly in my book, but I think that overall, things were much better than they could have been in this episode. The inflation was too high for sure, but it had to have been higher than target. How high it had to have been, I don't know, but we did avoid a big recession. I don't think that ending the Fed is really feasible. It's certainly not politically feasible. There have been times in history when the gold standard did work pretty well. I assume people who want to end the Fed want to go back to something like a gold standard. It would be hard to go back to it unilaterally. it worked well when there was a lot of kind of international coordination and cooperation and commitment to the gold standard internationally. I don't see anything like that happening anytime soon, and I don't see people believing in the credibility of the gold standard in the way that they would need to for it to work the way it did when it worked well.
Well, since you brought up the gold standard, during the Bretton Woods era, inflation was relatively low and stable. Is that just a correlation, or is there causation there?
Bretton Woods was something like a gold standard, but not exactly a gold standard. And I don't know that we can say that like the Bretton Woods system really helped control inflation. The kind of rules of the system were not that functional, and we did get like the seeds of the great inflation sown during that time. Yeah, it was a strange system, and it didn't, I don't think, work exactly the way it was intended to work.
We couldn't, in theory, return to that system today. It wouldn't be possible.
Well, yeah, I don't think you'd be able to get the international agreement you needed. The Bretton Woods system came out of the end of a world war when people really felt like we need to do something to, the gold standard had been destroyed. They felt like they needed something to fill the void, and they needed to coordinate in a way that would, maintain the global order and prevent going back to some sort of world war like that. And I don't think now you have either that sense that there's this kind of void in the international monetary system that you need to fill, or any way to get the kind of agreement necessary to get there.
Well, forget ending the Fed for just a minute. How do you feel about the Fed's dual mandate, which is not something that all central banks have? Should the Fed keep both mandates or just abandon the full employment part?
Well, the Fed can't decide to abandon it. It would be Congress that would need to decide. I do think that having the price stability objective kind of like a step above the employment objective clarifies and makes more transparent what the Fed's goals are, because those two parts of the mandate can be at odds with each other sometimes. And when they are, we don't know what the Fed actually plans to do. And that's why I personally think something like an GDP targeting mandate would be quite valuable, because that, I think, provides a good balance where you're still going to have good outcomes for price stability and for employment, but you have a single target. So there's more transparency, and it's easier to predict what the Fed's going to do and to hold them accountable for their goals.
Well, that seems to be at odds, or at least that's the concern right now. If the Fed keeps rates higher for longer, on the one hand, they're fighting inflation, we're bringing it down towards 2%. On the other hand, they may risk bringing up the unemployment rate. Is that a concern for you?
Yes, that's a concern. I think so far the labor market is still strong. I mean, if one thing about full employment is there's not a set number that you can, gauge it by. Like with employment, with inflation, they can say we have a 2% target, but they can't say we have a 4% unemployment target or a 5% unemployment target, because that kind of, if there is some kind of true full employment unemployment rate, it's always changing depending on the structure of the labor market and different kinds of demographic trends and all sorts of things. So there's not really a way to measure it.
Yeah. So generally speaking, you think the labor market is not going to deteriorate further, is your view?
I think if rates are kept high for a long time, then the labor market certainly could deteriorate. But I think so far it's not, it hasn't deteriorated to the point where we're not at maximum sustainable employment anymore.
Thanks very much for your updates. Where can we learn more about your work? I mentioned you have a book. Where else?
Sure. I'm on Twitter at CConces. That's CConces. And you can also just Google search me and find my webpage, my Google Scholar page to find all my papers. Yeah.
They're pretty advanced readings, but we'll put the links in the description anyway for people interested in checking them out. Thank you very much, Carola, for your time. And we'll speak again soon.
All right. Bye.